Hello, welcome to the first lecture video on Chapter 18, where we're going to revisit the revenue recognition principle. When you took Accounting 1, you probably learned that the revenue recognition principle basically says that we record revenue when the earnings process is complete. A couple of years ago, we had to revise that standard. That was the old standard, but we had to revise it because companies and with their technology and all of the improvements that they've made, sometimes it was a little iffy in determining when the earnings process was complete. One company interpreted that another way, whereas the investor would interpret it in a completely different way. And it really led to certain companies overstating their revenues. So now, because of that, the revenue recognition principle includes a 5-step process that outlines and delineates specifically how we determine whether or not the earnings process is complete. So instead of using the language, oh, the earnings process is complete, we really use the language, the performance obligation has been satisfied. But within those 5 steps, we outline what the performance obligation actually is, we assign a number to it, and then we just assign or determine factors that help us realize whether or not that performance obligation has been satisfied. So in this chapter, really reviewing the basics of recording revenue. So a lot of the journal entries you will have seen before, just we're changing some of the details, and there are more details included in the problems so that you can apply the 5-step process. But the real problem portion of this chapter comes from the appendix, where we look at long-term construction contracts and how we record those long-term construction contracts. So there has been some conversation, there have been conversations for years about FASB converging with the international standards or the US adopting the international standards. But the US didn't adopt the international standards, but there has been a push towards convergence, where some of our principles, some of our GAAP principles have been changed in order to have more consistency across the board, because we're in a global economy. So as I mentioned a couple of minutes ago, with some of the standards, they were unclear and there were inconsistencies, and some companies were able to report higher revenues than what they should have been able to report. So now we have the new revenue recognition standards. So rather than focusing on, is the earnings process complete, we now look at it from an asset or liability approach. Rather than focusing on the revenue itself, we look at the asset or the liability that arises as a result of the earnings process being complete. So what are the assets and liabilities that arise from those contracts? Well, accounts receivable, or it could be unearned revenue if it's a situation where we've gotten the cash without providing the service. And we're also required to analyze all the contracts with the customers so that we can assign the correct number to that asset or liability that has resulted from the contract, and in turn assign a correct number to the revenue. So within the 5-step process for recognizing revenue, we have to first identify the contract. And then we have to look at or identify the separate performance obligations. And when I say performance obligations, I mean, what is the corporation supposed to do? What is the customer supposed to do? Then we determine the number that we're assigning to those performance obligations, or the transaction price, or the total transaction price. If there are more than one, or if there is more than one performance obligation, then we have to allocate the transaction price to the separate performance obligations, because one may be a service revenue, the other one could be revenue that's a result from a particular product. So we do have to allocate that transaction price. And then we recognize the revenue once the performance obligation has been satisfied. So here is the resulting revenue recognition principle after we go through this 5-step process. Now, with some things, the 5-step process is pretty straightforward, especially when it's implied through customary business practices. With others, we really have to look at the contract closely. So we're going to use a fairly simple example with Boeing and Delta Boeing signs a corporation to sell airplanes to Delta for $100 million. So first we have to identify the contract. Well, the contract is simply the agreement that says that yes, Boeing, we're going to sell, or yes, Delta, excuse me, as Boeing, we're going to sell you some airplanes for $100 million. What are the separate performance obligations? Well, there's only one. All Boeing has to do is provide the planes to Delta. Now, if Boeing would have said, we will sell you these planes and we'll maintain them for the next 10 years, then that's an example of two separate performance obligations. There's a revenue source from selling the planes, and then there's an additional revenue source from providing the service of maintaining the planes. But in this example, just one performance obligation. So because there's only one performance obligation, we can collapse steps 3 and 4 into one. In step 3, we determine the transaction price. We said this was going to be for $100 million, so that was pretty straightforward. But because there's only one performance obligation, we don't have to do the allocation. It's still the $100 million. All Boeing has to do is deliver the airplanes to Delta. And in step 5, the revenue does not get recorded until the planes are delivered to Delta. So Delta can pay for them today, and that's great. As Boeing, we'll record the cash coming in, but we can't record that as a revenue until the planes are delivered to Delta. That is what the contract outlined. So it really doesn't change what we've learned, what you probably learned in Accounting 1, depending on how long ago you took Accounting 1. The earnings process is complete when the goods are delivered. We just don't use the term earnings process because then that's focusing on the revenue. We want to focus on the asset or liability that results or that arises as a result of the revenue. So the focus is on the performance obligation, not the earnings process. So let's see another example. And this one is another pretty straightforward example, but we can throw in some twists and turns that can really make this a headache. But we have to, because we have to see this 5-step process work out. So in this example, we have a coffee company. They essentially have, it's a coffee shop. Customers can come in and purchase coffee beans, or they can purchase coffee, or they want to purchase a muffin. So similar to a Starbucks. So in this particular example, we have a customer coming in and ordering a large cup of black coffee, and the customer gives $3 to the barista, and the barista pours the coffee in a cup and gives it to Tyler. How much revenue should the corporation or being recognized on this particular transaction? Well, this one is pretty straightforward because we see that the cup of coffee costs $3. There's only one performance obligation here, and that's for barista or the barista for Bean to deliver the cup of coffee to Tyler. If Tyler ordered coffee and a muffin, there would be 2 separate performance obligations. But all Tyler ordered was coffee. So we can go through our 5 steps. In step 1, we have to make sure that a valid contract exists. These are the characteristics of a valid contract. First of all, the contract has to have commercial substance, or in other words, both parties should be in a better position as a result of executing this contract. Tyler's better because he gets coffee. The company Bean is better because they get money for providing the coffee. So there's an exchange with where both parties are in a different economic position. Now, both parties have to approve the contract. If Tyler walks into the store and approaches the counter, then because of the implied customary practice that if you walk up to a counter, you're actually going to order something and pay for it, that is the approved contract. The rights of the parties have to be established. Once Tyler places the order, Tyler has the right to receive the coffee, and Bean has the right to get the $3 that the coffee costs. The payment terms are identified. When Tyler walks in, he can look up and see all the signs that say if you want a large cup of coffee, it costs $3. So we know what Tyler would have to pay. And it's probable that consideration will be collected. Typically, most people don't walk up to a counter and order a cup of coffee if they don't have enough money to pay for it. So it's reasonable for Bean to expect that they can collect on the $3. And in this example, Bean actually does get the $3 before it delivers the coffee. So the consideration being collected is definitely probable. So it is a valid contract. Now, in step 2, we have to identify the separate performance obligations. Let's see how this could change, because in the first example, or the one that we just saw, there was only coffee. But the following day, Tyler comes in and orders another large cup of coffee. I guess it was good. Came back the next day and purchases 2 bagels at a price of $5. The barista provides the products and Tyler pays $8. How much revenue should be recognized on the purchase of these 2 items? So in this one, there are 2 separate performance obligations, the bagels and the coffee. We're typically going to keep track of the bagel revenue and the coffee revenue separately, because if I'm losing money on the sales of coffee, I need to know that. If I'm combining all that revenue together and putting it all in one account, then it's going to be hard for me to disaggregate that data. So we disaggregate it from the jump. Now, in order for us to realize that there are 2 separate performance obligations, each product has to be distinct and not interrelated or highly dependent. In other words, I can have coffee without a bagel. I can have bagel without a coffee. But let me give you an example of something that is not distinct. All of the ingredients that go in the bagel are necessary for me to have the bagel itself. So when I record the revenue for the bagel, I'm not going to record the revenue that is allocated to the wheat and the eggs and all of the other ingredients that go into making bagels. I'm not going to do that. It's one cohesive product. If I sell just all the ingredients separately, then the customer still has to make the bagel themselves. But what we're providing is a distinct product in the bagel and a distinct product in the coffee. Sometimes there are certain transactions where the products are interrelated and it still ends up being one performance obligation because those products are interrelated, and you can't have one without the other. We'll see a couple of examples of that. But for this example, the coffee and the bagels, 2 separate performance obligations. Now let's look at step 3 with another example, determining the transaction price. So let's say that Bean changes things a bit and they decide to offer an additional incentive to their customers. They roast their own coffee beans and they usually sell them to grocery stores and restaurants on a wholesale basis, but they decided to sell it at their store, at their retail location. So on Tuesdays, because it's a slow business day, they decide that maybe we can increase our sales by offering a 12-ounce bag for $9. Bean usually sells these 12-ounce bags for $10. But on Tuesday, when a customer comes in, if they buy it on a Tuesday, they can get it for a discounted price of $9. The question is, when the customer comes in on Tuesday and buys the beans, how much do we record the sale of those coffee beans for? Do we record it at the 10, because that's what we normally sell it for, or do we record it at the 9? These are some of the issues that come into play when we have to determine the transaction price. Now, the transaction price is typically net of any discount or any coupons or any rebates that we may offer to our customers. So in those situations, we're going to record the transaction price at the 9, not the 10. Yes, the 10 is what I normally sell it for, but I have to record my transaction price at what I can reasonably expect to collect. And if it's Tuesday, I can't reasonably expect to collect $10 because all the customers know they can get it for $9, and that's what they're going to pay me. So be careful on the transaction price. Make sure you're showing that net of any coupons. Now, what about allocating the transaction price to the separate performance obligations? in step 4. So let's look at another scenario that isn't as straightforward. So now Bean wants to provide even more of an incentive to customers to buy its coffee beans, as well as purchase a cup of coffee. So now every customer that buys a cup of coffee will also get a $2 discount on the purchase. Said it backwards, I'm sorry. Every customer who buys a bag of beans, coffee beans, will get a $2 discount on a purchase of a cup of coffee. So now instead of getting coffee for $3, they can get coffee for $1 as long as they're willing to pay $12 for the beans, the coffee beans. Now, how are we going to record this transaction? Well, there are several allocation methods that we can use. And for this one, we're going to allocate the price, the standalone price for each one of these items. We're going to allocate that based on, again, the standalone price. So what we're doing is, I know that the standalone price for a bag of coffee beans is 12, and I know that a large cup of coffee is 3. The problem is that the customer is not going to give me $15. They are actually going to give me $13. They're going to give me 12 for the beans and 1 for the coffee. So we're still using that same allocation method that we saw when we were looking at the proportional method in some of our previous chapters. Same method over and over again, only the base this time is the standalone selling price. So we come up with a percentage. We know that the entire standalone selling price of both of these items is $15 by adding the 2. We take the individual standalone prices and we divide it by the total to come up with the percentage, and then we multiply that times the entire transaction price of $13. So when we record this entry, the revenue from the sale of the coffee beans will be $10.40, but the revenue from the sale of the coffee will be $2.60. Not the $3, not the $12. So we can allocate using the standalone selling prices. Now let's get into each step further. All the examples we saw were good in terms of giving you a jumping off point and how we can see different things change, but let's dive deeper. So in step 1, remember that we have to identify the contract with the customer. The contract doesn't have to be in writing. It can be oral, or it can just be implied from what we normally do in business, like when the customer walks up to the counter and orders a cup of coffee. But again, that agreement has to include at least 2 or more parties, and there has to be some rights and obligations that are enforceable. So we can see a bunch of different examples, and some of these examples I'm going to skip just because it's pretty straightforward. You can go back and look at this on your own when you get some time. But what I do want you to pay attention to is the fact that the journal entry here is pretty much the same as what you learned in Accounting 1. So for this one, on March 1st, we entered into the contract. But there's nothing to record as of March 1st because no one's received any money and the performance obligation has not been satisfied. So they entered into a contract to transfer the product on July 31st. And it's structured that the customer will pay the $5,000 a month after we provide the product or deliver the product. Once the goods are delivered, the performance obligation has now been satisfied. Again, we don't do anything on March 1st. Entering into a contract does not require a journal entry because no one has received anything. No one has the right to receive any payment because nothing has been done as of yet. And then on August 31st, we know that we're going to show the cash coming in. So the journal entries are a repeat of the steps that we have to take to get to the journal entries. It's really what's new, but it's not new because you already know how to record revenue. Now, step 2 is where we identify separate performance obligations. And we have to make sure that that product or service is distinct. And it's distinct when the customer can benefit from that product by itself, or they can combine it with other resources that they can get from someone else. They don't have to get those resources from us as the seller. When that happens, the product is distinct and not interrelated, and it is a separate performance obligation. Now, here's an excellent example. I love this example. Let's assume that GM sells an automobile to the dealers at a price that includes 6 months of telematics navigation services. Now, these services are typically sold on a standalone basis. And after the 6-month period, the customer can renew the services with General Motors. And the question is this one separate product, or are these two, is this one interrelated product, or are these two separate products? Now, in this example, the products are distinct in that they can be sold separately. Keep in mind that after the 6-month period, if Marquardt, however you say that, if they happen to sell that to a customer, the customer can continue to get this product from General Motors by paying a fee. So the products can be sold separately, and they're not necessarily interdependent. You can have a car without the remote diagnostic services. You can have a car without the navigation. Now, let's see. So because you can have one without the other, the products are not interrelated or interdependent, and they can be sold as two separate and distinct products, two separate performance obligations that we have to account for separately. Now, let's see one where it's one performance obligation. So for this one, we have a software company that sells or licenses customer relationship software. In addition to providing the software, they also provide consulting services, and the consulting services are needed to customize the software that's being given to that particular customer. With those consulting services, you can't make the software without the services because you don't know what the customer wants. So in that situation, these are one in the same. SoftTech does not sell the software. Excuse me, I'm coughing. Excuse my coughing fit. It seems like every time I lecture on this topic, it just chokes me up. I don't know what's going on. But the point is that SoftTech does not sell the software without providing those consulting services, because the consulting services are needed to create the software. So because of this, this is accounted for as one single performance obligation. So let's dive deeper into determining the transaction price. We saw an example earlier where we used the standalone selling prices to help us determine the transaction price when we were allocating that transaction price. And sometimes those methodologies are necessary. But before we can even jump to that step, I'm ahead of myself on step 4, we have to do step 3, where we determine the amount that we can reasonably expect to collect from a customer. So we have to take into consideration sales returns and allowances. We have to take into consideration the time value of money, any discounts that we may offer. All of those things have to come into play. So remember that we need to record our revenue at the amount that we are most likely to collect, that we expect to collect. So because of that, we can't include any discounts or rebates. We have to subtract all of those items out, even though they may happen in the future. Sometimes in dealing with the expected value, we may have to perform a probability calculation to determine, especially if the amount of revenue that we receive will change depending upon when we finish or when we provide the goods or services, if there's some type of performance bonus. We'll see an example like that. And again, it needs to be at the most likely amount. Now, here is my favorite example here. And only because every time I talk about this, year after year, I typically only teach intermediate 2 in the spring, but year after year, there's always some type of del dot construction that's going on that I can always use as an example of variable consideration. So let's look at this example, and then we'll talk about del dot. So we have this construction company entering into a contract to build a warehouse for $100,000, and they'll get a performance bonus of $50,000 as long as they finish it on time. Now, that performance bonus will decrease by 10% for every week that they go beyond the completion date. So management estimates there's a 60% probability that they'll finish on time, and there's a 30% probability that it'll be done a week late, and there is a 10% probability that it'll be done 2 weeks late. So how do they record this revenue arrangement? Do they record the entire thing at $150,000? Or do they deal with the variable portion because they don't know whether or not they're going to finish it on time? Now, so we have to use this probability weighted method where we know that there's a 60% chance of finishing on time. So if we finish it on time, we get the full 150. There's a 30% chance of being 1 week late. If we're 1 week late, we still get the full 100,000, but instead of getting 50,000, we get 45 because it's reduced by 10. The performance bonus is reduced by 10% each week. And then there's a 10% chance of getting 140,000. So we sum all of that up. And if they don't think that they're going to finish on time, then this is the number that we're going to assign to the transaction price. But if they believe they're going to meet the deadline, then we can deal with the 150,000. So whatever the most likely outcome is. So we have to use a predictive approach. Now, this always reminds me of Del Dot, because Del Dot, a lot of times, they'll contract out the jobs that they have to do. And a couple of years ago, well, they've been working on 141 for the past 15 years. But there was a stretch of 141 along Basin Road that was closed for a really long period of time. And we were told they are going to be done. This company said they're going to be done by January. And I don't think they finished until March. But there was a performance bonus assigned to that. They definitely didn't get their performance bonus because they didn't finish on time. So right now we're staring down the barrel of the 95 project. And this is a 2-3 year project, and I'm sure there is a performance bonus for the portion of those jobs, the portions of those jobs that have been contracted out, and the performance bonus is there as an incentive to get those people to finish on time so that we're not all sitting in traffic for the next 3 years, 2 hours a day. But the companies that are on the receiving end of that performance bonus, they need to take that into consideration. And if they don't think they're going to finish on time, then they have to use this probability weighted method to help them predict how much they should receive. If they think they're going to finish on time, then they're good to go with recording the contract at 150,000. So keep in mind that a lot of our financial statement numbers are estimates. So estimations, as long as they are reasonable and we have a systematic way of estimating, then we're okay with using it. Time value of money, this comes into play when there is an interest component. So we have to take that into consideration. And we've seen that when dealing with our discount on notes receivable. So there's some interest revenue, some interest expense that we may have to consider. So yeah, you've seen that entry before. And there's the interest revenue being recorded for the zero interest bearing note. And then for non-cash considerations, when goods or services are exchanged instead of cash, then you're typically using the fair value of what was received or what was exchanged. And then we also have to take into consideration the discounts, the rebates, trade discounts, coupons, all of those things impact the receivables that we record on our books. So as a result of this revenue recognition principle, there are some additional allowance accounts and things that we have to estimate for. We now have to estimate for sales returns and allowances. So in this example, this company was offering a volume discount, and we record the amount of accounts receivable net of that volume discount because we're not going to get that money. We deducted that from the regular sales price. And when we get the cash, we just take the receivable off the books. Now, of course, if the customer doesn't pay us within that period that we require, then we have to deal with sales discounts forfeited. So this part is a repeat of what you learned in Intermediate 1 when we were using our gross method and our net method in order to record our receivables and our sales discounts. And this, of course, is the net method. But the net method is there because of our new revenue recognition principle. We have to show our revenues and our accounts receivable at the amount that we can reasonably expect to collect. Now, in allocating the transaction price, this is where we can use fair values or standalone selling prices. There are a couple of different methods. Sometimes that information, those fair values, is not available if we typically don't sell the product on a standalone basis. So these are a couple more approaches that we can use. There's the adjusted market assessment approach. We can look at other companies that may sell products that are similar to what we have, or if there are other products in the market that are similar, then we can look at that and maybe adjust up or down based on the needs of our own company. There is the expected cost plus a margin. So we may not know the fair value, but we know how much it cost us to produce this product. So we'll look at our costs and then we'll adjust it upwards for a reasonable margin or a reasonable profit. And we'll use that as the fair value to help us allocate the transaction price. Or there is the residual approach. If I know the fair value of one item, but I don't know the fair value of another item or the standalone selling price of another item, then I'll go with the one I know, and then the rest of it goes to the one that I don't know. Very similar to the incremental method that we used in previous chapters. So I'm going to skip this, because we saw an example with allocating the transaction price. And then in step 5, the hardest part of this is determining when the performance obligation has been satisfied. And these are some indicators that can help us determine whether or not the earnings process is complete. So if the company has the right to payment for the asset, and a lot of times the right to payment happens because the goods have been delivered. If the company has transferred legal title to the asset, so they've signed it over to the customer. Once the customer has a legal title, they also have the risks and rewards of ownership. They can do what they want to do with it because they now own it. So those two kind of go hand in hand, but those are indicators that the earnings process is complete. When the company has transferred physical possession of the asset, so when they've given the asset to the customer and the customer has actually accepted it. Now, not all of these have to be in place at the same time, but all of these are indicators that typically when they are in place, the performance obligation has in fact been satisfied. So in summary, step 1, we identify that contract. Doesn't have to be in writing. It can be oral, or it can be a result of implied business practices over a period of time. Then we identify the separate performance obligations, and those separate performance obligations have to be distinct and not interrelated or interdependent. Then we determine the transaction price, but we have to take into consideration any variable considerations like coupons, rebates, discounts. Take into account time value of money, use that fair value if it's non-cash consideration. And you also have to make sure that you're showing the transaction price at the amount that you can reasonably expect to collect. If there are separate performance obligations, then you need to allocate, usually using the standalone selling price. But if you can't find the standalone selling price, then use one of the other methods that we discussed. And finally, we're looking for our change indicators to help us point to whether or not the performance obligation has been satisfied. So for this portion of the chapter, there's no real walkthrough video because you've done journal entries for basic revenue and when you collect cash for the customer. But take a look at the next walkthrough video where we get to see the next lecture video, where we get to see specific examples that are sometimes exceptions to the rule and applying the five-step process in some of these items that require special attention. I appreciate your time and attention, and I hope you have a great day.